When it comes to living a comfortable life, the majority of us are working extremely hard. Some are attempting to be the best in their chosen field of employment, while others are devoting their time and resources to developing their enterprises. Many people strive to retire with $1 million or more stored away in their bank accounts when they reach retirement age. Being a millionaire is not an impossible ambition to achieve. If you keep your progress on track, you could be a millionaire when you are ready to retire. Greetings to all of you. In today's episode, we will cover 10 essential steps that'll assist you in how to retire as a millionaire. But before we start, make sure you click the like and subscribe buttons on our channel. Many people envision themselves retiring with $1 million portfolio. Making that ambition a reality will need a significant amount of effort. While there is no guarantee of success, the 10 steps mentioned below will go a long way toward assisting you in achieving your goal. Maintaining these habits throughout your professional life will likely amaze you with how simple it is to earn 7 figures by the time you reach your retirement years. First, you need to set your goals and envision your objectives. Just like planning for your vacation, setting your itineraries, or just listing your weekend routine, you also need to envision the goals you need to achieve to retire as a millionaire. Although no one intends to fail, a large number of people do not plan ahead of time. It is a common refrain, but it is true. Planning is the most common piece of self-help advice given by athletes, corporate leaders, or ordinary individuals who have accomplished amazing feats. To retire as a millionaire, you must first create an appropriate retirement plan that will last for a long time. One excellent approach that could help you is to contribute to an employer-sponsored retirement plan, in which your employer contributes employee payments. Additionally, you can include establishing a strict budget and spending only what you can afford to your list of objectives so you can avoid being enslaved by severe credit card debt. Starting to save money as soon as possible is the second step you should take. It is impossible to obtain your financial goals if you do not save. While this may seem self-evident, far too many people never even begin to accumulate savings funds. Joining a plan through your company is a terrific way to put your savings on autopilot and increase your retirement savings. Simply enroll in the program and contributions will be deducted from your paycheck regularly, building your savings while simultaneously reducing your actual tax burden. Additionally, always keep an emergency fund on hand in case of unanticipated financial obligations. If your company will match your contributions up to a particular percentage, be sure to give enough to receive the entire match. In a sense, it is like receiving an assurance on your investment. Obtaining the money to put aside may be difficult, especially when you're young. But do not allow that to discourage you from reaching financial independence shortly. Also, keep in mind that the earlier you begin, the more time your funds can increase. Third, take a close look at your current asset allocation strategy. To build wealth over time, fixed income investments such as annuities, which provide fixed payments that cannot be increased or decreased, are not likely to be effective. This is because inflation has the potential to devour a significant portion of your savings. According to research, asset allocation determines the vast majority of returns earned by a given investment. Investing in equities has a higher level of risk, but is also statistically more likely to result in higher profits. If we want to see our money develop, most of us will have to take a risk to see it expand. When it comes to investing, asset allocation approaches can assist you in learning how to select the proper combination of securities of the central component of your plan. Recognizing the possibility of setbacks is an essential part of long-term planning, and acknowledging the losses is the next step you must follow. Setbacks can put a halt in your saving initiatives if you are not prepared for them. Even though you cannot prevent all disruptions on the road, you can plan ahead of time to minimize the harm that they cause by always keeping emergency savings on hand. This reserve will also assist you in avoiding the accumulation of consumer debt or the inappropriate withdrawal of funds from your retirement account, both of which are standard methods of dealing with unexpected expenses that might risk your financial security. The fifth step on our list is for you to save more money. As time goes on, your earnings should increase. This will obtain promotions, switch occupations, and possibly get married and start a family with 2 incomes. Every time your salary increases, the amount of money you set aside should increase as well. The most crucial step in achieving your objective as rapidly as possible is to save as much money as you possibly can. We have already completed half of our list, and we are gaining a great deal of knowledge today. I hope you are enjoying this video, and if you are, please give it a thumbs up and subscribe to our YouTube channel so that you can be regularly updated with every video that we upload. Now, back to our topic. Aside from saving more money, you also have to keep a close eye on your spending. Vacations, vehicles, children, and all of life's other expenditures can eat up a significant portion of your income. If you want to save the most money, you must spend the lowest amount. If you're going to increase your savings, you must first purchase a property that you can afford and then live a lifestyle below your bounds and not financed by credit cards or other personal loans. Also, you need to keep track of your portfolio. There's no need to concentrate on every change in the stock market. Instead, review your portfolio at least once a year to ensure that everything is in order. It is critical to rebalance your investment portfolio regularly since it might help you get your asset allocation back on the right path. The performance of your assets can create changes in your investment portfolio over time. Suppose you have 10% of your funds invested in stocks, but if those stocks do well over the next year, they might account for a more significant portion of your overall investment 1 year later. Because of the fluctuating value of your investments, your asset allocation may no longer be consistent with your investment objectives, requiring the need to make changes to your portfolio. Furthermore, it would be best if you exhausted all your possibilities. Take advantage of all savings opportunities that present themselves to you. Allow compound interest to do the heavy lifting for you. Over a lengthy period, this can account for a significant portion of your savings. Aside from that, make the maximum contribution to tax-deferred savings programs and then set up a taxable investing account to complement them. Do not let any opportunity to save your financial journey pass you by. When you reach the age of 50, you can make higher contributions to tax-deferred retirement accounts. Make the most of the opportunity and do so wisely. The Internal Revenue Service refers to this as a catch-up contribution. The term catch-up contribution pertains to a type of retirement savings contribution that permits 50-year-olds or older to make additional payments to their individual retirement accounts. When you make a catch-up contribution, the total amount of your contribution will be greater than the usual contribution limit. Last but not least, try to be as patient as you possibly can. Schemes to become wealthy quickly are typically just that, schemes. Obtaining 7-digit funds does not happen overnight, and it will take you a significant amount of time and effort to achieve this goal. Investments must be made early and frequently to benefit from the power of compounding. Investors should be aware that the road to wealth is often long and winding. Keeping this in mind, the sooner you begin, the greater your chances of reaching your objectives. Furthermore, potential millionaires stick with their plans no matter what. They stick to their long-term saving and investment plans and do not drift away from them. All in all, retirement may seem like a long way off, but once it arrives, no one ever worries about having an excessive amount of money. Some individuals even debate whether $1 million is sufficient. Determine whether your retirement income goal still makes perfect sense by putting that notion to the test in your situation. Despite various setbacks, you can achieve your retirement objectives and enjoy a decent life after work with careful planning and dedication. That brings us to the end of our video for today. We sincerely hope you gained some additional knowledge from us. Let us know what you think about today's video in the comments section. For more helpful financial advice, check out our YouTube channel. And if you enjoyed this video, please do not forget to like and share. Thank you for watching, and we will see you next time.